We will wait just a few minutes to get started here. Let us go live on all the different platforms. Appreciate everybody tuning in. We did put the chat up on the screen, so you can go ahead and drop a comment there in the chat while we wait to get started here. We are streaming live on YouTube, Facebook, Instagram, and LinkedIn. So thank you everybody for tuning in across all platforms. Just give us a second so we can make sure that we're live on all the different platforms before we get started. Thank you everyone there for commenting already. Jason, Zanara, Christina. Thank you for tuning in. We'll get started in just a moment. Adam, good morning. Good morning to the Mortgage Calculator team tuning in. Hope everybody's been having a great week so far. We'll get into it here momentarily. Good morning, Africa. For those that just tuned in, we're just waiting just a minute to go live on all the different platforms. So feel free to drop a comment. Rudy, good morning. Mark, good morning. All right, it looks like we are live, so we can go ahead and get started. Welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every morning here on this show is go through the live mortgage rates for different programs, and then we do a deep dive into a different topic every day. Now, today's topic is something we're very familiar with here at the Mortgage Calculator because we do specialize in non-QM loans. Today's topic is 2 to 8 unit mixed use properties. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and realtor, is going to do a deep dive into that topic here momentarily. But before we do that, like we do every morning, we'll have Nick go ahead and pull up our pricing tool so we can see what the mortgage rates are looking like today. So Nick, let's go ahead and pull up the pricing tool and see what the market looks like.
All right, let me go ahead and switch my screen and we'll get started. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. This will show us the general rates and the APR with all the costs. For today, it is June 28th, just after 11 a.m. Eastern. So all of our standard programs have some new rates issued. If you'd like a full loan estimate with a breakdown of all the fees that go into the APR, please get with our team members. We have over 300 licensed loan officers, and we can do primary and second homes in 24 states total. And we can do our DSCR business purpose loans in 44 states. So please get with one of our team members if you'd like a breakdown. But for today, we will set the pricer up with a general scenario and compare across programs. So we'll set a loan amount of $400,000 for all of our demos. We will set the LTV to 80% loan, 20% down payment. We will set the desired price to $99. That means we're going to ask the computer to find the best rate at one discount point in price. That's the days. And then we're going to compare our different programs here. So we'll first check out conforming conventional loan programs. Then typically the next option is FHA. And then we'll go into some live rates for our expanded guidelines, aka non-QM, where we have over 5,000 alternative income programs. And we also offer VA and USDA. VA is only for eligible veterans and active service members. If you are eligible, let us know. We'd be happy to quote it in just a few seconds, but not everybody is. And same with USDA, that's only for eligible properties in a USDA eligible area, a rural area. If you are shopping in one of those areas, let us know. We'll quote it, but not everybody is, so we don't do that live. So we'll start today with conforming conventional, as we always do. We will do a purchase, 30-year fixed standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos today, we'll use an estimated FICO score of 760 to income ratio of. So with those basic settings, let's check the rates this morning. And not much action. Everything's still the same as it has been pretty much all week. So today, same as it's pretty much been, 6.875 rate, 1 discount point in cost here for a final APR of 7.042. So good option here for our customers that qualify conventional. Haven't been much change this week or last week, really. We've been right around here at about 7 on the APR, pretty much nationally. So let's check out the FHA, see if we have any movement there. Typically, the next option for any borrower that doesn't quite qualify conventional is going to be an FHA program. So we'll set up the same demo and we'll choose FHA here. FHA does allow a little more leniency on credit events and other types of guidelines, as well as a much higher debt to income ratio. But for our demo, we will keep everything exactly the same so we can compare apple to apples and use the APR. So let's check the APR this morning for FHA. And again, not much change here. It looks like almost the same as it's been all week and last week. 6.125 rate, 0.75 discount points in cost, and a final APR of 6.709. So in this scenario, if our customer qualifies for both conventional and FHA, it's actually a little bit cheaper in this case for FHA. So the FHA is coming in at about 0.3 cheaper on the APR. So our customers that qualify for both definitely don't look over the FHA. It's a great option. And for our customers that need it, these recent improvements to the funding fee for the FHA mortgage insurance, have been changed this year. So it makes it a lot more affordable. Now, if our customers don't qualify for conventional or FHA, that's where we specialize. Many other banks or lenders don't have other options, but that's where we love to present our expanded guidelines, also known as non-QM. So if we set up the same exact scenario, everything else the same, you'll notice one new option pops up for our non-QM programs, and that's our income verification, because all of our programs allow alternate income. So we will typically select this option to choose an alternate. Full doc is 2 years of tax returns. That's what we have to use for conventional and FHA. So we will typically choose one of these other options, including asset-related programs, business bank statement programs. Our investor programs are just for investment properties. We'll do that in a minute. Personal bank statements, 12 months. That's our most popular by far. So that's what we'll use for our demo. We got RSU, stated, VOE, 1099, P&L. No income at all, CDFI type loans, all kinds of different options. For our demo, as we do every morning, we will choose our most popular option, our personal bank statement 12-month program. That's for our self-employed borrowers. Many times our self-employed borrowers, when they try to use 2 years of tax returns, have different write-offs or maybe haven't even filed their taxes, and it becomes complicated, or they don't make quite enough income to qualify for the home they really want. So in this case, we're going to solve any problems for our self-employed borrowers. Instead of using tax returns, for income, we're simply going to use their last 12 bank statements, no tax returns involved at all, to determine a debt to income ratio of 40% in this example, using their actual cash in the bank instead of tax returns or anything else. So most of our self-employed borrowers will qualify with double, triple, quadruple the income using these methods, and therefore can get the home they really want. So let's check out the non-QM rates this morning using bank statements. So good option at the top, 7.25 rate, a little bit more discount points, 1.875, but the final APR here is the lowest option, 7.346. So remember, conventional was just over 7, and here we have a non-QM option using alternative income for just a little bit more cost. So we get excited here at the Mortgage Calculator when our non-QM options are very affordable and very comparable. So definitely recommend all of our borrowers out there shopping can compare all 3 different options for a primary home, and they're all very comparable. A lot of flexibility is afforded when we go with a non-QM. Not only can we use bank statements, but if you'll scroll down here to maybe some of these other programs at a little bit higher rates, they may allow things like foreclosures and bankruptcies and other loopholes in the guidelines that would otherwise disqualify us. So non-QM has a ton of flexibility. Please get with our team members. They'd be happy to find the one that fits best for you. Now, before we go into Jose's deep dive, we always want to do live rates for investment properties. So for our final 2 demos, we will set the occupancy to investment. So we love to work with investors, whether you're a first-time investor, get your first investment property, or you're a seasoned investor with dozens of properties. We have some great options. So let's set up our scenario, 80% loan to value, 20% down payment, everything else the same as before. And we're going to compare our conforming conventional options for investment properties to our non-QM expanded guidelines options. Remember, FHA, VA, USDA, all the government programs are not eligible for investments. So first we'll select conforming. Everything will stay the same as our prior demos. The only thing we've edited here is the occupancy. So let's see what adjustments the GSEs have here for the conventional investment properties. So the best option this morning, 7.375 rate. But unfortunately, with the price adjustments for investment properties, there are no one discount point options. So this one has 3.25 discount points of cost and a final APR of 7.617. So a great option here for our customers that qualify for conventional. But many of our investors ask for other options. Most investors don't mind going up in rate a little bit in order to reduce the discount points. In this case, this is $13,000 that our investor might want to spend elsewhere. So the solution to that, unfortunately, there's not many conventional solutions to that. We're just stuck here at high discount points. So that's where we love to present our non-QM options. Definitely recommend any investors check out both options. So we'll set up our final demo today. Investment property, 80 LTV. And when we select expanded guidelines, we have our new options that pop up here. First, we select our income verification. And as I mentioned before, our most popular option for investment properties is going to be our DSCR option. That's actually our most popular loan by far here at the Mortgage Calculator, really our flagship product. And that's because it doesn't actually require any income or employment from the borrower. We're simply going to use the estimated rental income from the property to determine a DSCR value, debt service coverage ratio. So if the estimated rents from the property cover the PITIA of the mortgage, that's a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. It makes more money than it costs. Now we even have options for a DSCR ratio under 1.00, aka the property doesn't quite cash flow on a monthly basis. But for our demo today, we'll just go ahead and delete this. That way we can see all the different options. And finally, we must set a prepayment penalty that is standard on a non-QM investment property. So we always select 3 years. That's pretty standard. There are options for 0 that will cost more money and limit the amount of loan programs. So we don't do that on our demo. And same with 5 years. There are options to save us some money to have more prepayment. However, not all loan programs allow it. So in order to show the most common options, we will select 3 years. So with these basic settings, let's check out the DSCR rates this morning. And good option here at the top, 7.75 rate, 0.975 discount points of cost. So solve that problem for our borrower that wanted to go up in rate a little bit in order to reduce discount points. And the final APR of 7.816. So remember, conventional is like 7.6, and we have a DSCR option at 7.8. So that's absolutely amazing. We get excited when the DSCR options are almost the same as conventional. And it shows almost, I'd say over 95% of our investment loan applications end up taking advantage of the DSCR rather than conventional for many of these reasons. For one, it's easier. Our investors can do 1, 2, 5, 10 loans at a time, refinance multiple properties, purchase multiple properties, and a lot more flexibility within the guidelines because you don't have to use any income. And if you scroll down here, some of these ones at a little bit higher rates may have different DSCR values if we need, may have different prepayment penalty values, and some may allow things, as I mentioned before, that the non-QM programs allow, such as foreclosures, bankruptcies, other credit events, and also some of these programs at the higher rates may allow things like short-term rental income. So we love these programs. There's tons and tons of options. Please get with our team and they'll find the best for you. And now we're going to go into Jose's deep dive, which is one specific option that's on this list, but it's a very specific and very cool option. So let me switch my screen real quick, and we'll get into Jose's deep dive topic for today, which is going to be on 2 to 8 unit mixed use properties. So we did the training last night where we went over kind of structuring these, more of our loan officer training. Today is more for the customers out there as well. Let them know about these products. So Jose is going to have some live quotes for us. But first, Jose, let's have you talk a little bit about what makes these programs special and how we can get into these, and then we'll get into some live rates. So if you're ready, go ahead and take over.
All right.
You got frozen?
I'm a little frozen here. I think there was too much going on in the background. Can you hear me there?
We can hear you. I think it's just choppy.
All right. I think it'll smooth out in a second. Let's give it a second here. So, mixed use product, like we were mentioning last night, is an option where we have residential and commercial component to the property, right? So you have to have at least 50% of the property residential in nature. And like we were talking yesterday, we have minimum square footage on the residential component, have to have at least 400 square feet for each residential unit, have to have excuse me a second here. All right, I closed up a program here, which I think, here you go, smooths things out a little bit. So the residential components have to have kitchens, full kitchens, and has to have a bathroom, which means you unfortunately would not be able to have like a boarding house type property, or anything like that. They have to be at least 2 stories, and there's certain commercial options that aren't allowed, like nursing homes, churches, any type of a manufacturing, gas stations. They're really looking at more professional offices, retail, other things like that. So, and minimum DSCR on these for the best case option is 1.1. Now, we do have our preferred outlet for this, which is going to be most of the rates that you're going to see, but I'm also going to share a rate for you with lower credit scores at the 75% LTV, so you could put into context the rates that we usually offer when it's a preferred deal, and then those where it may be a little bit of a fallout deal, where it could be the lower credit score that still wants to do the 75% LTV, or it could be the lower DSCR of 1.0. Maybe it doesn't meet the 1.1, you meet the 1.0. So it would be in our secondary option. But the one that really wows them is the one that we love to share, which most of our borrowers fit into that bucket, where the rates are essentially, even though it's a mixed use product, the rates are essentially the same as your regular 1 to 4 unit DSCR, which is super cool, right? The other thing to note on this product, that it's not constrained by the zip code analysis that most of the commercial conduits will do, where when they're sizing up your deal, they're going to ask you for the zip code. They're going to look at the population density. They're going to look at other demographic components of the zip code, and they're going to tell you yay or nay based on that initial analysis, without even looking at the DSCR, without even looking at the credit score. The option that we offer here is more of a residential hybrid. So they're not going to look at the zip code and immediately disqualify your property based on that. That's very important. It's very important, because that used to be one of the biggest stumbling blocks for this product, for this property type. Besides income and all that, but the zip code would usually sink a lot of properties before they even got a chance to swim. So 760 plus is the highest tier for this product. So at 760 or above, it's going to be the same rate and same LTV. Once you start dropping below 760, there are adjustments, and I'll show those all to you here. So here, look at these rates here. Right, so you're looking at, and this is a 750 purchase, 25% down, $562,500 loan amount, and you're looking at lender credits even available here. So if your customer doesn't want to have if they want a quote unquote no points loan, they don't want to have to buy anything down, you're looking at 9.375 is actually giving you a lender credit of $844. You can still get a lender credit at 9.25, and then you can buy it down all the way to 8.25%. Most of you, if you size up this deal on a true commercial conduit, you're going to find the rates, should I say on a true commercial conduit with a 30-year fixed rate, because we do have commercial conduits that offer just a 5-year term that could be based on a 20 or 25-year amortization, or they could offer a 10-year term based on a 20 or 25-year amortization. Those rates are obviously going to be a little bit different than when we're looking at a fully amortizing 30-year term loan, which is what your average investor is going to want. They're not going to want to feel the pressure of, in 5 years, my loan balloons and I got to do this all over again. So here, you, as I stated, you can buy it down all the way to 8.25%. Now, at a 740, in other words, 740 to 759 scores, you can still do 75% LTV. The rate increases by 0.125 due to the credit score dropping below 760, but maintaining between 740 and 759. So here, you're looking at still, you have some lender credits possibility here, but you can buy it down all the way to 8.375, whereas in the other example, it was 8.25, and the lender credit rate was 9.25. So here, rates increase by 0.125, but most importantly, you can still do 25% down. Your typical investor is not going to fret about 0.125 increase in interest rate if they can still keep 25% down option. Great news is you can still do 25% down with a 720. Again, the rate increases in this case from the 760 rate, the rate increases by 0.375 due to the credit score being 720 to 739. But you can still get a lender credit at 9.625. You have an $844 lender credit, so we do have an above par rate, which is great. And they can buy it down all the way to 8.5%. Keep in mind, this is a non-TRID loan for those MLOs out there watching this. So we would do our 5% test on this, since it is a non-TRID loan, and all these rates that we show here are compliant for this loan amount. So you would be able to buy it down and still be in compliance on your loan all the way down to 8.5%. Now, this is our secondary option, which I mentioned to you. I would show you just to put it into context here. This is a 700 to a 719 credit score option. Still allows you to come in with 25% down, but it does come at a cost. Also, in this option, something I didn't I mentioned in the other one in the comments, but I didn't mention it verbally. In our preferred option, vacant units are they allow you 90% of the 1007 market rent income for a vacant unit, right? That's pretty good, and it allows you up to a 35% vacancy rate. With this option, due to being a little bit riskier due to the score and still maintaining the 75% LTV, they only give you 75% of the income on a vacant unit. Keep that in mind when you're structuring your deals if you have vacant units, because that could make or break your deal. Also here, you'll see now the rate 10.249 with a buy down cost, right? There is a high buy down cost there, 2.3, 2.4. The other thing to note is that the rate for each 0.125 decrease in the rate, it does cost you 0.25 points more. So you can see for your borrower that insists on 75%, When I show you the next example at 700 at a 70% LTV, the pricing is going to be so much better that you could almost make up the LTV difference by the lower cost on the rate, at which point your borrower would be much better off at a 70%, right? And I'll show you that example right now, because here you see 10.249 costs you $15,654 simply to stay at 75%. But now here we're back to our preferred option, 90% of the 1007 income on vacant units, and look at these rates. So you could actually go 9.5, get $131 lender credit, right? And you would still be, let me refresh my memory here, 10.249. So you would be almost 0.75% lower in the rate, and you're looking at about 3% in fee difference. So for 2% net difference in extra down payment net to the borrower in their pocket, they would have 0.75% lower rate, much better loan, and would end up having a lower payment. Because here your payment is $44.14, right? And over here your payment is $5,040. So you're going to make up that if you have any difference in LTV, you're going to make up that difference very quickly with this lower payment and $131 lender credit. And if they have the funds, well, they can buy it down even more and have even more of a benefit. So it's really important that you always do those side-by-side comparisons for your investors so you can show them the benefit of our preferred option. Now, at a 680 credit score, we still have great rates here, but it's 35% down payment. But, rates are back. These are almost the same rates that we had at a 760 plus credit score, right? So you got 9.375 with a $122 lender credit, and you have 8.25 as your lowest rate option. And last but not least, now, here I only have purchase options, but in tonight's training, we're going to go deep into all these structures. We'll have purchase options and we'll have refinance options as well. Here, I wanted to show you just a continuum of where we are in terms of LTV with the rates. 660 is the minimum credit score for any of these options that we have on the multi-unit mixed-use product. So here, I'm showing you our best rate option, which is 10.125, costing you $488, and you can buy it down all the way to 9.125, and this is with 35% down at a 660 credit score. Remember, we can always offer credit simulations to our borrowers to see how we can bring them up to a 680 or a 700. A lot of times it's as simple as just paying down a credit card a couple $1,000s. And if they have the money and if they have the time, if you do that when you're pre-approving them, not when you're in the middle of the loan application, right? Because you're going to do a pre-approval, you're going to set them up to be able to make the offer. Remember to offer those credit simulations to your borrowers so that they can improve their position and get to the LTV that they want to be. It's not, you can't be lazy as a loan officer and not offer it just because you're in a hurry to get into the loan, because in the end, that loan may not close because of the obstacles that you may face simply because you didn't offer their credit because you didn't empower them with the knowledge to do so. Most of them would gladly do that if you gave them those options and empowered them with the knowledge. That's part of being a loan consultant. And at the Mortgage Calculator, remember, all of our credit reports include credit simulations. So remember to use all your tools so that you can get a lot happier closings at the end.
Great. All right. Well, as we talked about for our loan officer training tonight at 7 p.m. Eastern, we're going to do another deep dive into this part 2. So definitely for the loan officers out there, tune into that. Thank you, everybody, for tuning in. Remember, we do this show 11 a.m. Eastern time every single weekday where we go through the actual live mortgage rates and then do a deep dive into a different topic like we did today. So thank you, everybody, for tuning in, and we hope to see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.